I think it's a very interesting and a very important topic at this stage about the need to strengthen the capital markets, especially given where we are today as a country. And I'll divide what I'm going to speak to in three parts. I think the first part, obviously, I'll speak to and partly reemphasize everything that's been said so far about the role of the capital markets. Secondly, I'll speak to what I want to call specific institutional voids that I believe are necessary to drive and strengthen the capital markets. Then I'll speak to the role that the NSIA is playing in addressing some of these and what I believe are some of the opportunities and challenges that we should be looking to address in the effort to strengthen the market, the capital markets, our financial markets, as a way to achieve double-digit growth for the economy. Let me start by saying a couple of things. Obviously, in various ways, all the past speakers have alluded to the link between the financial markets and as well as economic growth. And a lot of these speeches and correlations have been drawn from the work of Professor Joseph Schumpeter, who made a case, especially in his theory, by stating that there was a nexus between financial markets and economic growth. And he concluded that innovation and entrepreneurship are the driving forces of economic growth, and these forces will only thrive when the economy can successfully mobilize savings and allocate resources efficiently, reduce problems of information asymmetry, improve risk management, all of which are core factors in a developed financial market. And I think over time, different countries have approached this by evolving and developing institutions as they go along to make sure that they can achieve this objective. In a nutshell, of course, this is really the key things that have been said so far. The financial markets are supposed to aggregate surplus resources and channel them into the areas that are needed to make sure that we can drive markets. The Nigerian capital market and the financial market is still in many ways nascent and underdeveloped relative to the size of the economy. In many markets, of course, you expect that the store of wealth and the size of the capital market should reflect both the strength, the depth, and the diversity of the economy. I mean, on the extreme, on one hand, you have the United States, where the stock market capitalization to GDP is at 205%. You have in England, the United Kingdom, is about 100%. In Nigeria, we have ranged somewhere, I think the latest data is about 13.5%, which is the stock market capitalization as a ratio of the GDP of the economy. So where does it give? Where is the gap? And what do we need to do to make sure that we can block this gap? The other thing that you also observe with various capital markets and financial markets in other places is the way the market evolves to reflect the growth drivers of the economy. For many years in my past career, I think for 12 years, I was an equity analyst covering various sectors, particularly semiconductors. And in the 1990s and 2000 era, the United States capital market was dominated by banks. 30% to 35% of the capital market was banks. If you go further back in the 70s, it was mostly industrial companies, Dow's, DuPont, Steel, Nucor, USX. Today, more than 35% of the US companies, capital market is dominated by technology companies. In fact, less than 6 of them dominate something in order of more than 15%, 20% of the market. It continues to evolve. Not necessarily at the expense of one versus the other, but they all form this very virtuous circle that strengthens the economy. It continues to grow, the capital markets grow along with it. But it always must reflect two things: the depth and the diversity of the drivers of the economy. Are we there yet? The answer is obviously no. And there are many things that I think have led to this situation, and I will profile some solutions. Obviously, I'm not a player in the capital market, at least not in the depth that I'd like to be. But we are observers, and one way or the other, we are all affected by it, and as a consequence, we must all play a role in driving this. When I look at the capital markets, the other things that are very important, that I think are very, very key to ensuring that some of the comments made here about restoring confidence are adhered to is the governance, and particularly the governance of the stockbroking sector. The role of stockbrokers in many ways, and it's a whole sub-industry from analysts to brokers to traders to bankers that all contribute, is primarily in price discovery and efficient channeling of these resources. Underlying all of that must be firm, strong governance that ensures that people can have faith in order to store their wealth in the capital markets. Different countries have evolved their behaviors very differently. In the United States, again, something in the order of 60% of the typical allocation of your savings retirement plan is in the stock market. Some other countries is in the housing market, but those housing markets either get reflected through a restructure that ends up again in the capital market. The reality is that this is a credible store of wealth for people over time, and as a consequence, the responsibility of ensuring that we govern it properly is extremely high and must be adhered to. So we're talking about how do we strengthen it. This is one of the things that we must ensure that over time restores the confidence of people in the markets. Accountability of the issuers, very important. Again, this is a key role that the capital market overall performs. Obviously, the first judge of whether a company is running well is what happens to the share price of that company. But the second judge is actually how we as buyers of those shares hold them accountable through the role again played by brokers, played by investment banks, and played by all the entities that drive companies in the stock market. All of this must come together, because to the extent that we must hold issuers and companies accountable, our market will strengthen, there'll be more faith in that market, and people will come in. That is really how I see it. And it's a very simplistic view, and I keep trying to emphasize that these things are from a very, very small area of observation. Let me speak a little bit about NSIA, because I believe there is an interest in hearing what it is that we do and how we believe we can play a role here. The NSIA is a fund, and it's one of those institutions that I believe has been set up across a whole broad mosaic of institutions that are necessary to drive capital markets effectively. And it was set up with a very complex mandate. The mandate of the NSIA is very unique because, unlike other sovereign wealth funds in the world, who do not invest in direct infrastructure or make direct investments in their home markets, the NSIA is required to do so. 3 mandates. One is to provide a saving space for Nigerians, which we actually implement through the Future Generations Fund. The second is to provide stabilization support, which we provide through the Stabilization Fund. And the third is to enhance Nigeria infrastructure we invest through the Nigeria Infrastructure Fund. Now let me speak to how this all interconnects, because I will not spend too much time on trying to talk about the NSIA. I've spoken at length. Some of you know, and if you don't, please access our website to speak to. So I'm going to narrow my description of this to the specific areas of the roles that we play and where we see the opportunities. Number 1, strengthening the capital formation process of the country. In the NSIA, through the Future Generations Fund, we have played this role through investing in private equity, investing in venture capital, and investing in a lot of infrastructure funds that exist in the country. At the heart of capital formation is venture capital. That is really what helps entrepreneurs get started, followed on by private equity, followed on by bank loan, followed on by many other things that we believe are all very, very important in making sure that we drive entrepreneurs to play a role in the market. The NSIA has invested in just about every private equity company that existed in Nigeria, because we believe these companies will then help bring these investors will then help bring these companies to the point where they become a credible player in the market. And when these companies grow, they can then become listed in the stock market. But there isn't enough of them. In our company, at the NSIA, we've invested in more than 35 private equity companies. Sadly, we have only less than 7 that are in Nigeria. We want to encourage and we want to hope and encourage many of these entities to be created, because over time, these are all part and a very important part of the capital formation process in the country. So we're speaking about what we're going to do to strengthen this, ensuring that these entities exist that can bring small companies in a much better corporatized version that can make them listable in the market is extremely important. So I believe this is one area we should focus and drive. Secondly, I also believe that there are many other enabling capital market entities that must be created and strengthened. For example, recently, and I must commend the NGX Group, but I will commend NGX Group for the creation of NG Clearing. NG Clearing is a recent entity that is a derivatives clearing house. Very important because the derivatives sector is very important in allowing investors to express their views of certain stocks without taking direct equity position in the market. I'm proud to announce that the NSIA is a key investor in NG Clearing. I believe we hold about 14% shares in that entity, and we're hoping that this will play a role in making the capital markets liquid. It's a new organization. I want to hope that it is successful, because when it is successful, it will actually help in improving liquidity in the capital market. So derivatives is an area that has been very weak in the country, and I believe that this is one that must be enabled and made sure that it works to drive significant opportunities for the market. The other thing that I believe that are also very important, and again, let me just step back a bit. The NSI, in investing some of this, has what we call financial markets infrastructure as an area that we invest in. So this is how we have ended up driving some of these investments. The other is infrastructure. One of the first observations that I made when I joined the NSIA, when I started the NSIA, was the fact that we believe that infrastructure bond market, which is very important to drive infrastructure investments, was very light and very, very weak. There were many things that were missing. One of the things we observed was that there was a lack of a credit enhancement facility to drive infrastructure investments. So the NSIA sponsored the creation of a company called InfraCredit. What does InfraCredit do? InfraCredit's role is to ensure that you are an infrastructure company, you can issue a bond. But when you issue a bond, we will then provide a credit enhancement or a wrap on some portion of that bond that helps you bring the cost of that bond lower. This was an entity 100% sponsored within the NSIA, but now we have other investors who are participating alongside the NSIA. AFC and a group out of the UK called the Private Infrastructure Development Group, who are the owners of Garantco UK, are shareholders. Many others have come with Tier 2 capital, KFW recently, AFDB, and this entity is growing really fast. Today, it has underwritten bonds worth $43 billion and has a pipeline of over $200 billion of bonds that it will underwrite. Now, I believe that this such an entity will be very important in ensuring that, again, companies access fairly priced bonds that they can then use to strengthen their companies and ultimately see these companies list in the capital market. I'll speak to a few other things. Recently, we started working with the central bank to revive the commodity exchange. Again, an important area that I believe works along the lines of the things that the NSIA cares about. We invest in agriculture a lot. We direct investments, we invest in agri-inputs, but we believe that this is one key institution that is essential, again, in making trading in agriculture a liquid segment that, again, strengthens those companies, helps them to list in the capital market. An economy with GDP dependent on agriculture to a large extent, over 30%, cannot but have a very viable commodities exchange. It must work, and we must make sure it plays a role that is viable. Again, these things are all the voids that I believe that exist in our financial markets that must be filled before we can become effective. I'll speak to a couple of other things. Again, these are all along the portal or the silo of financial markets infrastructure investments that we make. One of the early ones we invested in was a Nigeria mortgage refinancing company also. NSIA holds about 20% of this company. Again, I'm sure many of you don't know this, right? Okay, so I'll just speak to it as carefully and as slowly as I can. The NMRC's job is very simple. It is the equivalent of Fannie Mae in Nigeria. Most of you know this in the United States. You take a mortgage, you then refinance a mortgage. It's called the Nigeria Mortgage Refinancing Company. It has struggled a little bit for a number of things. It has struggled. It's there. The thing is, over $30 billion of bonds have been issued and largely utilized. But there are so many things that include the perfection of titles, for mortgages. These are things that must be fixed. You know, I don't want to veer into, many of you have read the book How Asia Works, but the reality is that there's a large stock of real estate, both land and houses, that must be only tradable if the titles are perfected. And once they are perfected and brought into the capital market, you will see the true size and depth of this economy. And I don't think that this, in many ways, have been properly reflected. So what the NMRC is doing is actually helping make mortgages more liquid. But state governments must make an effort from the geographical information systems that make it possible that these titles can then be easily traded. Okay, so until we do that, the asset sits there, does not add any value to the economy, does not eventually get listed in the country. I'm looking forward to a point where real estate companies are actually directly listed, not just as REITs, but directly listed in the capital market, because again, this is an important segment that must be strengthened. Another area that we have played a role is the Development Bank of Nigeria. Many of you don't know this, but we hold about, I believe, about 14% of the shares in trust for the federal government in the Development Bank of Nigeria. Again, a very important instrument and a very important tool in driving micro and small and medium-scale enterprises. Again, beyond just lending money to them, it's also by helping them corporatize. So ab initio, they have the right governance, the right strategy in place to ensure that these companies eventually make their way to the formal capital markets. I could go on and on and on, but the point I'm making here is that there are still many more voids that need to be filled across the country in ensuring that we can harness everything and strengthen the capital market. I will speak to a few more things quickly in the role that we play. The Presidential Infrastructure Development Fund, which the Minister has spoken to, is a fund that the NSIE manages. And I'm hoping that some of these things will eventually make their way to the market. How will it operate? At the moment, the federal government provides capital, the NSIE will bring its own capital, and then will be coming to the market, as the Minister of Finance had spoken to raise capital to make sure we finish these roads. They are the Abuja, Kaduna, Zaria, Kano Road, the Second Niger Bridge, and the Lagos-Ibadan Expressway. These are projects that are now being managed by the Infrastructure Fund, the Presidential Infrastructure Development Fund, that is managed by the NSIE. Now, I learned something working on these road projects. The first thing that I learned is the value and the size of the right-of-way that are associated with these roads. The Lagos-Ibadan Expressway, from the median, 45 meters both ways, are part of the right-of-way. 16 is only what you need for the road. The rest are entities that can be corporatized in many ways. And I just want to send a clear signal that part of the role we're going to play is to turn this into actual companies that manage these roads that again will find their way to the capital market. The summary of all I'm saying here is that many of these entities run properly will come into the market, and we will see that virtuous circle of the capital market, good quality assets that then grows to the point that we can achieve a higher ratio of capital market to GDP. I will stop here. There are quite a few other things that I would like to speak to, but I'll stop here by making two last comments. And this is something that I believe is extremely important. And that is the size and quantity and numbers of moribund assets in the country. Watching some of these companies not be able to fulfill their mandate for us has been something a little bit concerning and a bit heartbreaking, because some of these companies actually should make their way back into the market. A successful example of how some of these assets can be turned into productive assets is Temasek of Singapore, that pulled these assets into a second sovereign wealth fund. We're in a country where basic material companies are still not producing, from Alstom to Ajaokuta to quite a number of these things. These are things that, in my opinion, should be worked around, and if some of those things eventually come in and leverage the market, we will ensure that we will have value that will be brought into this country. I could speak about many other things, from healthcare to agriculture to gas industrialization, which are all areas of potential. But I'll summarize by saying, number one, stockbrokers, capital markets must make sure that they drive a level of confidence in the market for people to trust them as a store of wealth. Two, we must fill out some of these institutional voids, and there are many that are yet to be filled out, that will all work in a synergy that will drive better stock market growth. And I want to assure you that the NSIE, through some of the programs I have listed, will work not just with this group, but the entire capital markets infrastructure to ensure that we play a role. And I want to stop here and thank you very much for your time.
Let me stand on the existing protocol and then to thank particularly the President of the Chartered Institute of Stockbrokers for giving us the opportunity to be part of this great workshop. The theme of this workshop on leveraging the financial markets to achieve double-digit economic growth in Nigeria is quite opposite and a humble expectation of every patriotic Nigerian, if such an expectation will become a reality. Ladies and gentlemen, the implication of that topic is that in 10 years' time, 2029 or 2030, we would have been having about 10% growth in our economy. Is it achievable? I believe it is, if we work hard, bearing all the unforeseen circumstances. But I want us to take a look at certain imperatives. Prior to the 2016 recession, Nigerian economy was regarded as one of the fastest growing economies in Africa then. We are trumpeting it at 6.3% or thereabout. Then by contrast, before the COVID-19 struck, we are witnessing an economic growth of 2.2%. And today, it hovers between 1.8%. These are fundamentals, fundamental facts to guide and posit our expectation of the double-digit economic growth for Nigerian by leveraging on the financial markets. I may not have time to go through the whole papers, but we consider this workshop timely, and then with recourse to the above facts I've succinctly presented, it is expected that the insight from the conversations we will have today will really be of immense benefit to the individual, organization, and participants in this gathering. The National Pension Commission wishes to commend the Chartered Institute of Stockbrokers towards ensuring development of practitioners in the Nigerian capital market. Indeed, the strength of every institution depends on the capacity and the size of its human capital. And then the Commission aligns with the human capital development of an initiative of this institute. In aligning with the theme of this workshop and considering the financial market regulation, and then taking cognizance that whatever has been said today, the LCM of all the contribution lies in funding the capital market. And then I'm here to tell us, talking from the pension perspective as regulators and administrators, that there are opportunities to access the pension fund to strengthen the financial market for accelerated domestic production and employment. As you may know, globally, pension funds serve as long-term pool of funds that is increasingly being utilized for the socio-economic advancement of several countries. However, because of the nature of the pension fund, regulators and fund managers are bound by their fiduciary duty to ensure the safety of the funds, while also pursuing the objective of fair returns. Countries including Nigeria have developed their financial markets by creating innovative instruments that allows for the utilization of pension funds for socio-economic development in a safe and sustainable manner. Ladies and gentlemen, by the fourth quarter of 2020, Nigerian pension assets to GDP stood at 8.08%. The last speaker made a comparative analysis of some of the countries like US and then the UK, and then you can see where we are. This is considered insignificant compared to other countries within the African sub-region. South Africa pension asset to GDP is over 63.29%, and as at the same period with ours today. Regardless of the seeming insignificant figure, Nigeria is starting to reap the gains from the pension fund reforms that began in 2004. Prior to 2004, we have a deficit pension fund of 2 trillion naira. But today, I stand to tell us that we have a pension fund asset base of 12.657 trillion as of June 2021. The reform caused major shift in the pension industry, which was unfunded, marred by weak, inefficient, and poor administration, and prone to financial malpractices, to a fully funded pension system, which is highly regulated and provided a pool of funds to support economic activities and national development. I don't want to go into to bore you with some other things in this paper that has to talk about the Nigerian economy at a glance, the current situations, but let me go straight to tell us how can we access the pension fund to strengthen the financial markets for accelerated domestic production and employment. The pension fund represents a pool of funds for long-term funds that can be used for socio-economic development, as long as safety and returns on the funds are guaranteed. Currently, the investment regulation issued by the Commission allows for the fund operators, we have the fund operators, the pension fund operators, to invest in key sectors of the economy through these various investments. We have bonds, sukuk, treasury bill, and other securities, including bonds denominated in foreign currencies issued by the federal government and the CBN or their agencies, as well as special purpose vehicles and companies created or owned by the federal government. These are areas our funds can be invested in. We have bonds and sukuk issued by eligible state and local governments or state government agencies or wholly owned companies of the state government. The representative of the Lagos state government told you of the bond they issued and the one they want to issue next. We invest in such funds when the conditionalities are met. We equally invest in ordinary shares of public limited liability companies listed on the Security and Exchange Commission. Money market instruments of banks and commercial papers issued by corporate entities. Open and closed-ended hybrid investment funds, including exchange-traded funds and non-interest like the Sharia-compliant investment fund, which are registered with SEC. There are equally specialist investment funds whose underlying assets are tangible physical assets including real estate, private equity funds, and infrastructure funds, which must be registered with SEC. There are equally global depository receipt notes, Eurobonds, and Sukuk issued by or listed in the Nigerian companies. Ladies and gentlemen, despite the fact that the investment regulation allows pension funds to be invested in alternative asset classes as captured above, federal government securities remains the largest beneficiary of the pension fund with over 67.64%. That's about 8.57 trillion of the pension asset under management out of the 12.657 trillion as at June 2020. This is closely followed by investment in money market instruments, which accounted for 13.70%. That's about 1.74 trillion. Investment in alternative assets such as infrastructure funds, infrastructure bonds, real estate, and private equity funds accounts for 0.52%, 0.08%, and 1.87%, and 0.27% of the total asset under management, respectively. I have a table here which is not possible to let us have, but I can really go through it. The ordinary shares, total pension asset, investment in ordinary shares is about 948 million naira. That's about 7 billion naira. That's about 7.48%. The government securities, like I earlier said, is about 8.57 trillion. That's about 67%. Then we have corporate debt securities, about close to $1.95 billion. It's close to $1 trillion. That's 7.5%. Then the money market, $1.736 trillion. That's about 13%. These are table of where pension fund asset has been invested. One of the main reasons of relatively low investment of pension funds in alternative asset classes that have the potential to facilitate local production and employment is the dearth of investable instruments that meet the quality and requirement of the pension fund investment. While the Commission has put regulations in place to foster increased investment in the real sector of the economy, the financial market also needs to create an enabling environment for pension funds to be optimally deployed. Ladies and gentlemen, when we are talking about pension fund, we are talking about that fund that will keep the custody of, that is available for us to develop our economy. And with pension fund, I believe the hope of attaining a double-digit economic growth of our economy is a possibility. But there are conditions that must be met. And that is where the Chartered Institute of Stockbrokers and other sister agencies need to work on. Conclusion and way forward. For Nigeria to attain a double-digit growth, there is need to diversify the economy by developing the non-oil sector. So many speakers have harped on that. Pension fund, because of its long-term nature, can be deployed to support the development of the non-oil sector. However, this has to be done in a safe and sustainable manner. I keep on repeating, safe and sustainable manner as one of the conditionalities for you to access the pension fund. To achieve this, the key players in the financial market, especially the capital market, need to work with relevant stakeholders to develop innovative policies and bankable products that can meet the requirement of the pension fund investment in areas like infrastructure, housing, and agricultural sector, with potentials for employment generation and production. In this regard, cross-country capacity building and knowledge sharing is imperative because infrastructure financing is a new and evolving field in the market and needs to strengthen its capacity in this regard. Furthermore, private equity firms and other corporate organizations should focus keenly on building sound corporate governance structure, capital base, and business models that can accommodate the requirement of the pension funds, rather than seeking for a relax of the rules that have been established to ensure safety of the funds, as well as fair returns. In the same vein, the capital market needs to foster some level of innovation to deepen the market and promote the emergence of angel investors, private equity firms, and others. Ladies and gentlemen, in a nutshell, I want us to go home that we have a pool of funds in the National Pension Commission that is available. But certain conditionalities has to be met. So there's a proverb in my place: you don't need to have breast and you start sucking pus. There's opportunity for us if we want to achieve the double-digit economic growth for Nigeria to hasten up now and do the needful. The National Pension Commission and the Pension Fund is at your service. God bless you and thank you.
To speak further on these sub-themes and shed more light so that we can group all the thoughts together, provide clarity around what the Institute and its members need to do and what we will recommend to policymakers. Clearly, from all the discussions, there are things that we need to do ourselves in terms of ensuring that we have the credibility, we can have the trust of the investing public so that the necessary capital can be harnessed through us to increase production and employment, because this is the major issue in this country today, raising the national GDP as well as increasing the standard of living of people so that both economic and social issues that we are facing can be addressed. So let me start, lady first, let me start with my sister, please.
Thank you very much, Chairman of this panel. Let me quickly say that we at DMO, as most people know, we are part of the market on behalf of the government. So sitting here for me is really that we are with friends, family, and stakeholders. And let me say very quickly as well that when we're talking about growth and employment, the imperative is urgent. It is not something we're expecting to happen in 3 or 5 years' time. That's better. Mm-hmm. Given where we are today, if we look at the country's fiscal position and then look at the level of unemployment, especially among the youths, clearly there's need for acceleration to achieve this objective. So let me thank the organizers for choosing that topic. Let me also say this is about stockbrokers who we partner with in the retail product that we have, the FGN Savings Bond. I want to thank them for their services to the GMO and to country. Okay. Moving, thank you. Going specifically to the issues, I believe both presenters have sort of drawn out some of the main points that we need to look at. But I think we can start from where we are today and say, if we look back 10 years ago or 20 years ago, are we better than where we were? I think the answer is a clear yes, so we should be grateful or feel good about how far we have come. Some of the institutions that now exist didn't exist some years back. The products that exist now didn't exist then. So we have made some progress, and we should all be proud that we have, made some progress. And to buttress that, in the sovereign rating of Nigeria, I believe last year, early this year, by one of the 3 international rating agencies, one of the reasons they retained the sovereign rating that we had instead of, downgrading us was because we have a robust financial market. So if a rating agency can see that, we can see that as well, and then be encouraged to do more and get to where we ought to be if we are to achieve growth and employment. I think that's very important to put on the table so we don't go feeling like, oh, there's so much to do. We have come a long way as stakeholders, working collectively, whether with regulators, with operators like you, as well as borrowers or issuers like us. We have come a long way. Having said that, my contribution to this session is first to say that when working with a number of stakeholders, and I do defer to a number of the very senior people here who have a passion for the capital market. No, we don't have the time to mention names. I think one of the things we wanted to do as an FGN is borrow from the markets, basically to develop the market. Yes, there was a development stock market several years back, but we needed to restart it because technically what we had was, at that time, was a money market and an equities market, so something was missing. And most of us know that when they're teaching us financial management for companies, you need some leverage, and that leverage really is better long-term. A number of the senior people here know that was one of the gaps that the merchant banks filled many years back with long-term capital for investments, all the way whether in Papa Oshodi and all of that. So there is room for long-term capital, whether that is in equities or in bonds, whatever form, and we need to focus on that. So our own issue, like I said, we've collectively as a market, we've done well, and I've been told by operators that occasionally we actually, in terms of transactions and all of that, we actually, and stability, we do better than South Africa sometimes. So we've done well. I'm not talking about FGN instruments, I'm talking about the overall performance of the market. So we should be grateful. So where do I see areas that we need to focus on? So the first one for me is, each time I read the reports, and the president of the association does have daily reports that we look at, so we see both on email and on WhatsApp. I'm sure a number of you do, but I get that one and I do a quick read. We tend to see that in the fixed income space, a number of the issuers are the regular names that we know. So I'm looking, where are those other names? So if it's not those names coming in themselves, maybe just be some SPVs, then I see fairly significant number of the transactions are commercial papers or notes or something. And I'm looking where are the other names that we expected to bring that to drive the economy, and where is there a focus on short-term paper, commercial. So when in engaging with some of those potential issuers, it is a case of, okay, there are policy considerations, there are interest rate considerations. So some of this we have to table at the appropriate level. So I'm saying we've achieved a lot, but the diversity and the depth we're expecting to see, there are still gaps that we need to achieve there. So I had put another point, a bit differently from what Uche Oji had put, but fairly similar. So I'm saying if we look at the market, a lot has been done, to bring in the smaller players. But really, if we look at the topic, we want to grow GDP. Who should we be looking at? Who constitutes a larger proportion of our GDP? It's the informal sectors, the SME. So if what we're looking at are those big listed companies that we grew up to meet in existence, and I don't think a number of them are actually maybe investing for growth or capacity, maybe they are retooling or taking working capital. If those are the only people we're looking at, for whatever reason, maybe we don't have the risk appetite, which is the other thing I wanted to discuss with my brother from Bencom, then really where will growth come from? So my challenge is, in looking at moving the capital market forward, should we still be looking at those old regular names? What should we be looking at for growth based on the GDP? So I think really we all know the answer. We should begin to look at those other entities, the SMEs. What are the constraints? What are the issues? When you read what some of them say, they don't access to capital, they talk about infrastructure. Okay, let government do infrastructure. Access to capital. What should we do? So I'm saying that I think we need to expand the territory and begin to look at those sectors. What is it that we need to do? When I say Uche, you made reference to it. So he talked about the US economy, how it moved from one to the other. We can't stay with those PLCs that we knew many years ago and expect to grow. I'm not sure they are doing massive employment and all of that. Maybe just maintaining market.
Yeah,
so,
yes, patient,
sorry, one more, I'll finish.
Okay.
Thank you. So we need to look at that. And then what I'm saying is, what kind of appropriate funding mechanisms do we need to develop? The focus has always been on risk and risk and risk. So when we speak with the pension funds, whether individually or as an association, and my brother here talked about it, if risk is the only reason that is the main reason why we won't invest in various things, including infrastructure. Okay, come fund infrastructure. No, you must guarantee principal, interest, and if there's foreign exchange, you must guarantee everything. How does that work? It doesn't really help the development of the economy for growth, and it doesn't help with the creation of employment. So I think we need to broaden our horizon a bit and begin to say, really, when you're investing in something, in the minimum, the risk should be shared, not passed entirely to one entity. So that's what we see. If PPPs work, for instance, those private sector entities will come to the capital market to raise money, and there'll be more diversity, more volume, and all of that to promote growth. But it doesn't work. Everything has to be guaranteed by the government. So on our part as a DMO, we are saddened because that means for many of the projects, it has to be on-balance sheet borrowing, including some that Uche just mentioned now. There's no need to raise money to support those projects. That's not how it should be. The 3 roads he mentioned, I imagine should be commercially viable on their own, if, well structured and the revenues are collected. So I just want to put that on the table, that let's begin to think a bit differently and tie our plans, let it mirror the GDP. And if there are structural constraints, those are the things that we should talk about. And then maybe we should look at risk a bit differently. Thank you very much.
Thank you, Patient. Mr. Apem Agbaje, if you recall when Oji was making his presentation, he said we are 13%. And looking at the history of the American capital market, so something that was not there is now 30%. Is it an area that we as a nation can leverage now, and also working with both private equity, this sector of fintech, to bring more institutions to the capital market? Because the time to market for them seems to be much faster than the traditional industrial sector.
Thank you very much, Chairman. I would directly address your question, but let me first stress the imperative, endorse the topic of the conversation today. Because if you look at it from the 2016 recession to date, Nigeria's economy has not grown above 2%, the maximum. And it has twice been in negative territory. That's over a period that is stretching to 6 years. So it's probably not an accident. It's becoming a pattern of sub 2% economic growth. So there must be something missing. And our challenge is to find that thing. I like Mr. Uche Oji's contribution in terms of identifying the institutional voids, because that's a key part of what is missing. Identifying the institutional voids and trying to fill them. But we grew
as somebody has said earlier, at an average of 6-7% for a decade before now. So one other thing that you find that is a contributory factor then must be our dependence on oil. So there's the imperative that Ucheoji has mentioned of filling the institutional voids. There's also the imperative of going beyond slogans in terms of our desire to diversify our economy, especially to diversify the sources of government revenue and the sources of exports, because that's what it boils down to. GDP has been relatively diversified, but not our exports and certainly not government revenue. So we fill the gap of oil with borrowing more or less, rather than finding new revenue sources. So that's the first point I'll make. Beyond institutional voids, dependence on oil, and the narrow export base around oil, I suspect that we have to go a little bit more fundamental in finding out why our economy continues to grow. Now, like I said, it's a pattern of behavior at less than 2%. And I suspect that we would have to examine economic policy and management for some of the causes. Not stated policy, because you hardly can find anything wrong when you read policy documents. The Economic Recovery and Growth Plan, all of those documents are documents I endorsed. I thought they captured all the significant elements of what was needed in terms of economic policy. So maybe the problem may not be stated policy, but maybe it's a question of underlying philosophy and perspectives around economic management, returning to strong, credible economic reforms, focusing on generating investment, foreign direct investment and domestic investment, rather than lead development. Yes, there's an imperative of borrowing right now because of the shortfall of revenue, but the strategic emphasis should be on generating investment into the economy, and that's not easy. It's much more difficult than getting loans from the parties that have typically given us loans. So what we've seen, I mean, the government, to its credit, has used the financial markets to borrow, to fill budget gaps, to do some infrastructure projects, noteworthy the rail. But the key thing that we need to see is, are those investment vehicles around infrastructure bonds, around mortgage-backed securities, around those things that could take private capital directly into the economy at a faster pace, rather than the ones subjected to the characteristics of government borrowing. Now, in terms of the question the chairman asked specifically, yes, fintechs, for instance, can help in deepening the financial market, in bringing the formal people into the market, in widening the volumes around financial markets. Essentially, every time I look at the data around our financial markets, taking out intermediaries such as investment institutions who don't necessarily carry assets. For institutions that carry assets, we just have two segments in our economy. We just have two sectors within the financial sector. Essentially, the banks with deposit money banks with 44 trillion or so of assets, and the pension funds, which, as we now have heard, about 14 trillion of assets. The rest are marginal. The pension, the primary mortgage sector, the finance sector, all of the non-bank, even insurance is essentially marginal. So essentially, I do endorse turning to the pension fund. I do endorse the reality, because deposit money bank funds are typically not going to go into long-term development. So the reality as of today is that we must leverage the pension funds. Those are the real and the sovereign funds from the Sovereign Investment Authority. But the one that is really available to the private market has to be the pension fund. And we have to create vehicles, and our job as capital market operators is to continuously create the vehicles that can access those funds. I think we should be working on mortgages, mortgage-backed securities. I think we should be working on infrastructure bonds all the time. I acknowledge the limitation for mortgages in terms of interest rates and all those other impediments of the housing sector, but I think the work has to continue. One of the points which Yoji made, which I would like to reinforce, is that governments across the country have typically regarded land titling as a source of revenue generation, which is an economic error, a severe economic error. I think one of the things we have to stress as our outcomes of this summit is that state governments have to regard land titling and their associated geographical information systems as facilitators of economic development and liberators of capital. And it will be in the interest of the states themselves. Indeed, at an extreme, I don't necessarily advocate the extreme, but at an extreme, to give away land titles free to all of the people who own title, so that they can then liberate the capital that is locked down in all of those assets. My final point, because I do recognize that we have limited time, is the perpetual constraint around public spending, which continues to be around recurrent expenditure. So for as long as we marginalize capital spending, and to the extent that we've only managed to do a little bit of that in recent years from borrowings, but as far as public expenditure continues to be poured into salaries, pensions, overheads of government and its officials, then the massive infrastructure deficit that we have may persist. And therefore, we would be postponing, deferring economic development in Nigeria. Thank you very much.
Thank you, Prof. You've had the two discussants. You have your thoughts, but I would like you to also emphasize the area where the industry itself, now I'm talking about the financial markets and its players, especially the stockbrokers, how their behavior, their credibility, and what their acts of commission and omission is intending the growth of that market, and what they need to do to put the house in order as a feedback, so that at the end of this workshop, they have also something to carry home rather than just to the policy makers.
Thank you, Chairman. Good afternoon, everyone. I start by saying that the big question in this room is how do we strengthen financial markets to boost domestic production and create employment. I agree with the DG DMO that financial markets have done well, over the years, and that's also what the feedback we get, even in our tertiary institutions. Recently, I asked a group of students to evaluate the financial markets over the last 5 years, and the feedback was that financial markets have done well. I take the banking sector, for example. They will tell you prudential ratios, have improved. Speaking specifically with respect to non-performing loans, now below 10%. They tell you capital adequacy ratio is above 15%, and they also tell you liquidity ratio is above 30%. And there's little, to talk about the real role of the banking sector or the financial market, which is that of mobilizing, as we have said here, mobilizing from surplus units to deficit units. Of course, we know that in Nigeria today we still have a lot of challenges with access to finance, especially on the part of SMEs. So it's not just enough to say that yes, there's financial market stability with respect to prudential ratios, or that even the banks are doing well, they're posting impressive profits. That all those don't really speak to the role of the banks, because the primary role is that of mobilizing funds from surplus units to deficit units, and that's the only time we can boost domestic production and also create jobs. Now, with respect to the capital market, we know the situation too. Often we tend to analyze the performance of the capital market by just looking at the movement in the NGX index. Again, from experience, if you ask students to carry out studies on the capital markets, the proxies they use as performance of the capital markets are often the all-share index or market cap. So, for example, in 2017, they tell you that despite the recession that we had in 2016-2017, the capital market was adjudged the third best in the world because it returned 42%, next to Argentina and Turkey. And again, recently, we often hear that the market was again the best in the world because it returned more than 50% in 2020, despite the recession. But that again is simply about the movement in the index, and that again is simply about the reflection of what happens in the secondary market. Mere redistribution of, if you like, ownership of shares. Okay? The real job of the capital market is to assist in capital formation, is to mobilize funds from surplus to deficit. And that is why the challenge here is how do we strengthen the capital market, to also pay more attention to the primary segment of the market. Okay, a situation in which we have inactive primary market, where IPOs have completely dried up, and even if we have them, they're coming more from the government sector. That is what should challenge us, because it's only when we have companies coming to the market to issue shares, either as IPOs or as follow-ons, or we have governments coming to borrow, that we can really talk about capital formation. Capital formation will not happen when shares are simply just exchanging hands. Remember, the capital market is for medium to long-term funds, and for the capital market to play its role in job creation and domestic production, the primary market should come alive. And I want to make two quick recommendations here. The first is to say that the government has a major role to play, and that major role should begin from even the participation in the markets. The DMO, I'm happy she's here. If you look at the domestic debt instruments, the domestic debt by instruments of the DMO, you will notice that FGN bonds constitute over 75% of that. Okay. Yes, of course, the federal government borrowing from the market also helps to boost the market. But if those borrowing don't go into infrastructure or development, then there will be no domestic production and there will be no job creation. If you look at the composition of that debt instrument, infrastructure bonds, the ones I call infrastructure bonds, namely the green bond and the sukuk, represent less than 3% of the structure. So I would like a situation in which the government will do more of infrastructure bonds. And I'm happy to let my friend, and former colleague, the Commissioner for Finance, Lagos, is here. Okay, the bonds that are doing are tied to infrastructure. So the danger in having FGM bonds constituting 75% is that if you do just FGM bonds, general obligation bonds, and tomorrow labor is on strike, you will be forced, you'll be constrained to go and touch that money, even when it was not originally intended to be used for salaries. But when we do infrastructure bonds, we ring-fence such funds. Sukuk, for example, you ring-fence it, and you know that it's specifically going for particular projects. Abaje mentioned it. I also want to reiterate it, that there is need to use more of asset-backed securities, securitization. These are some of the strategies the government can also use to play a more active role in the market. There is no gainsaying the fact that privatization is also key. When we privatize, especially when we privatize through the exchange, I keep saying it, you may not have this inclusive growth that we all desire. The PIB bill has just been passed. There's a provision that NNPC Limited should be commercialized. But I've always argued that in that bill, in that act, is now a law, that there should have been a provision that eventually, whether it is 5 years or 10 years, okay, there should be a plan to eventually part privatize the NNPC. So privatization is one, and government, infrastructure bonds is another. The other recommendation I have is also tied to the question you asked me directly, how the players can also contribute, has to do with regulation, effective regulation of the market. I want to commend the efforts of the SEC and the self-regulators, that are here. They have done well. But for the market to be effectively regulated, based on my interactions with past DGs of the Commission, and based on also what we know from studies in other jurisdictions, effective regulation will come about, or will be better, if the DG of SEC, for example, is also the chairman of the board of SEC. Yes, you can raise issues of CEO duality, corporate governance, but the central bank didn't become independent completely until that happened. So I'm also canvassing here, I'm also recommending that in amending the ISA 2007, it should be provided that the SEC should be completely independent, such that the DG of the SEC also becomes the chairman of the board. Because when you have a politician appointed as chairman of the board, you can't rule out issues around influencing the decisions of the board. And the final thing I want to say here is that there's need for a handshake, a firmer handshake between the Securities and Exchange Commission and the Central Bank of Nigeria, between the regulators, as a whole. I'm happy that the Central Bank is represented here, but I will also want to see a situation in which, going in future, it doesn't have to be every year. You can maybe once in 4 years have a situation where the CIS, which will eventually transform to the CISM, and the Central Bank and the CIBN, because in a couple of weeks from now, CIBN will also be coming here to organize another conference and talking about the financial markets. Financial markets is money and capital market. So will it not be wise or good, once in a while, once in 4 years, for example, for CIS and CIBN to jointly organize a conference of this nature, with strong participation of the Central Bank of Nigeria, SEC, PENCOM, and other regulators in the market? Ladies and gentlemen, that's my submission.
Thank you. Thank you, Prof. Now is the turn. I will give one or two, because of time, one or two chances for comments and questions. So two hands have been raised, so we can limit to that. The first in front, please, the OSHA can.
Thank you very much, Chairman. Is this working? Yeah.
Go ahead.
Yeah. I hope you will indulge me a bit. But I must first of all commend Mr. Uche's presentation. It's the best presentation that I've seen on the dilemma facing this economy. I think we should take down his points as part of our communique. First, he talked about, I don't know how many people know, that when Delta Steel was completed, it was one of the 4 most modern steel mills in the world. It is lying idle. We are here borrowing money from Chinese to bring in Chinese steel, Chinese labor to build, our railways. And we say we are doing infrastructure. I mean, come on. That kind of infrastructure is not inclusive. It does not generate income for Nigerians. The growth is ephemeral. That is one. He also talked about Alstom. When Alstom was conceived, it was meant to be a way of expanding our gas exports because it consumes a lot of power. We can bring in bauxite from a mine that government had invested in Guinea or something like that. They sold off the mines in Guinea. Even we had an investment in an iron ore mine in Guinea. They sold them off. People just don't have a sense of history. They don't understand why certain things were done. Now, Alstom was privatized. It got immersed in a lot of problems. Recently, I read that they have concessioned the power plant attached to Alstom to produce power. I mean, come on, that is suboptimal utilization of the investment we have made. We have made great investments, but those investments are going to waste, and that's why we have unemployment. So I will commend that, people like Uche should really step up and keep harping on these issues. We talk about, expanding the capital market. He also talked about that. Venture capital funds, private equity funds must be encouraged, and they must be naira-based, not dollar-based. When you say a developing economy with a weak currency is growing venture capital funds and private equity funds that are dollar-based, the problem we have is that the hurdle rate for projects to be accepted becomes impossible to achieve, and therefore very few projects will be achieved. We cannot create employment, create double-digit growth without new ventures coming to the fore. And SMEs, look, let us be very frank. SMEs thrive also on the back of the huge companies. If you have your steel plants working, can you imagine how many SMEs will feed off those steel mills? Those are the issues for development. Those are the issues for economic growth. Those are the things that will produce, the double-digit growth that we are looking for. These things are simple. And I also like the idea that was mentioned by Mr. Nyerere about angel investors. Yes, it's all in the same line. PE, venture capital, angel investors. The good thing about all those things is that they strengthen corporate governance. When they step into those companies, they enforce corporate governance. When they enforce corporate governance, they tie those people to the market. They bring them to the market. That's how the market can grow. Well, Ms. Oniha, you said that why are other people not coming? Other investors, why are they not coming? The economy is not... Issuers, yes, the other issuers. Yeah. No, I can tell you, the problem is the economy is not growing. When the economy starts growing, issuers will come because they're expanding their market. A man who is running at 30% capacity is not coming to borrow anything. I mean, so those are the issues we need to address. On titling, I'm afraid I don't endorse government giving up the revenue. All governments need revenue. However, the problem we have is not the revenue focus. It is the administrative process. For some of us that were in the market before Land Use Act, we can tell you what happened. You can take your mortgage paper, sign it in the bank in the morning, get the mortgage registered before close of business on that same day. And you pay your stamp duty, it will be registered, it will be stamped, you complete the process in one day. What has happened is that the governors have arrogated to themselves the power to sign the consents. The consents can be administrative, even if you want to collect tax. If they understand the importance of these things, and I think Uche made it very clear, if they understand the importance of these things, I'm sure the Lagos State Commissioner is here. You can do the thing, collect the information. A man who sells property or buys property is not going anywhere. Collect the data. Approve the thing. Go and chase the revenue after. Let the business go on. Then go and chase the revenue you want to collect. They're not going anywhere. I mean, so let us deal with issues in ways that will solve the problems, rather than looking for problems that don't exist. Thank you.
My name is Egwahide Longe. I work for ICO Pension Managers Limited, but I am at heart a stockbroker. I think that the real challenge that we have in the end is systems thinking. Everything that Mr. Mobolori has said is, how do we join the dots? So many times we create the dots and we just drift away. And much of what we are seeing today is that there's been so much work, but the work does not amount to anything. And it is the same way for us as practitioners. We need to go to the heart of the matter. And the heart of the matter is, how much does it cost to get to where we want to go? So we should stop hitting and we should try to hit at the higher targets. And so what I think should come out of this is a proper engagement team and process that interrogates the issues in the right places. And just for what the DGDMO said about a different approach to risk, I think that risk is actually conditioned by the credit history and credit nature of your counterparty. And government has proven to be a very bad risk. And I don't think that we can trust government until they change their ways. And that's the reason why people are always asking for guarantees. But I like what you said about perhaps we should begin to start thinking of sharing the risk, 50-50, 60-40, 70-30, as the behavior improves. I think that would help, and it is very, very important for us to sequence, which is what systems thinking is, sequence the projects that we want to deal with. We don't have to focus on everything. If we are talking about rail is already beginning to go to waste because there's no structure around it. And so trains collapse in the bush, between Abuja and Kaduna. What's the administrative process around it? Who's managing the rail? So that infrastructure investment is already going to Alscon, and what else we have? We're throwing money away, we won't grow. We need to focus on those issues. Thank you.
Good afternoon, Chairman, panelists. Because time has gone really very fast, I'll make it very short and direct. Totally agree that Uche's paper was great, and the Commissioner also at PENCOM brought out certain salient points. But I want to go to Prof. This is a Chartered Institute of Stockbrokers, typically intermediaries who actually feed on markets based on the services they provide, both on the secondary market and slightly on the primary market. If I look at GDP calculation, Prof, correct me if I'm wrong, there's consumption, investment, government spending, and then net of exports that actually define GDP, which is what we use as the yardstick for growth. Now, when secondary markets actually do happen and flourish and increase the index because it's secondary market traded, what happens is that people have disposable income and go to the market and spend. When they do spend, it also creates its own multiplier effect in the economy. So what we typically see or say is that both the primary market and the secondary market make up what the capital market is. I just wanted to clarify that because brokers here feed on secondary market and it has an impact on our pockets and individual consumption. Thank you.
For being very good audience for this session. Thank you very much and God bless. Thank you.
Thank you very much.